Hello, friends. Welcome to this special episode of the Weekend Investing Daily Bites. Should you invest in falling markets? Is the question. Now, markets have been stagnant and falling for the last almost 18 months since October 21. We had a ferocious bull rally before October 21 from March ending 2020. Approximately 18 months of duration of a ferocious bull run where stocks went up several folds, many of them. And since October 21, we have been in a sideways range bound phase on the major indices. But if you dig deeper, then there have been reasonably large losses in small caps, mid caps, etc. If you see the average National Stock Exchange listed stock above 1000 market crore market cap, for instance, just let's take the important ones. In that cohort, the average fall is about 40%. So that tells you that the damage is reasonably deep and that the damage has mostly happened. If the average stock above 1000 crore market cap has fallen 40%, that's a reasonably steep fall. Now, we've also shown several times how the long term India market has played out, how we've had corrections of this nature several times in the past. How has the market, responded to those corrections? How have investor portfolios performed beyond those corrections? All that is there in several of the series that we have done to date. In this series, also, we created a part one of this question using Nifty, if you remember, and I'll give you the link to that video that we did. This is the YouTube video that we did on should you invest in falling markets part one, and this was predominantly focused on what happens if you invested in Nifty after every fall, after every 10% fall, 20% fall, 30% fall, and how what kind of CHGR, XIRR you would have made out of that exercise. So basically, to give confidence to users who are not looking long term, because this is eventually you need to understand and internalize the fact that markets, long only investing in markets, are a long term game. Markets will give you lumpy returns and then they will go sideways, they will go down. So there will be a duel of, you know, bulls and bears at all times. There will be short spurts and longer, time corrections post that. And this is part and parcel of the market. If we look at this chart, in the last 23 years, this chart is showing you those occasions where we had a more than 10% fall. So, whether it was the fall after March 2000, 2004, 2005, virtually every few years you will have decent corrections in the market, whether they're 10%, 20%, 30%. We've also seen 65%, we've seen 35%. So market is full of corrections, and that is the nature of the market. So that part we need to be very clear about, that the game is not just for markets to go up. The game is market will go up, come down, go up, come down. How to make money out of that? That is the real thing out of it. So in this part, we will look at how weekend investing strategies have fared from the same 10, 20, 30% drawdown. So earlier we saw how Nifty fared from 10, 20, 30% fall drops. And here we will look at how weekend investing strategies would have fared at several of these drops. So first and foremost, we look at India Top 10, which is the Nifty strategy. It selects 10 stocks out of the Nifty index. In October 2018, there was a drop in Nifty right here. If you had invested in that period at the end of October 2018, till today, you would still have a CAGR of 14.26%, a XIRR at 13.82%. So if you uh, uh, use that drawdown to buy, you would have resulted in a decent outcome. In March 2020, when you entered after COVID, the fall was, I think, more than 30%. The CAGR from that point is 20.27%. If you did a SIP, you still would have got a XIRR of 12.99%. So this column is telling you the XIRR. If you were SIPing from that point till today, this is telling you a lump sum investment if you made after that drawdown. So very, very healthy figures on both of them. NNF10, if you were invested September 18 after 10% drawdown, you would have made a CAGR of just under 10%. March 2020, post COVID, it would have been at 14.5% CAGR and 5.7% XRR. Jan 21, it would have been at 11.5% and XRR would have been negative. So you would have been in a loss if you were sipping since Jan 21. Since July 21, again, virtually no returns and XRR of minus 10%. And December 21, very recently, minus 7.9% and minus 13.7%. So you can see that if the period was longer, there was a better chance of coming out with a positive result. But if the period is very small, 1 years, 2 years, then there is a chance that the SIPs or the lump sum will result in negative if the market has been that way. If it was a 20% drawdown, which was the March 2020 drop, you would have gained 18.8% CAGR from that point. This March 2020 point is where the 10% drop happened and you entered at that 10% drop. So if you had waited for 20% drop, your CAGR would have been better and XRR would have been at least in positive. Now, MI Evergreen, which is a strategy that looks at CNX 200 stocks, the top 200 stocks, and a hedge of 25% gold to it. So it's a very, very unique strategy. And we are extremely proud of the strategy and the way it has performed. October 2018, 10% fall. Had you invested, you would have been sitting at 20% CAGR. XRR would have been 24%. March 2020, post COVID fall, 31% CAGR, 23% XRR. And May 2022, very recently, last year, 12.57 and 26% XRR. So extremely positive numbers, mainly because in the last couple of years here, uh, the CNX 200 has performed much, much better than the Nifty Next 50, for instance. And the gold component has added a lot of value to the MI Evergreen and giving it stability. MI20 is another strategy where you look at small and mid cap stocks. So again, you can see here fantastic outcome if you compare it from drawdowns in November 16, 24% CAGR, 25% XRR. Even after the crash of small caps in May 18, 19% CAGR, 29% XRR. And recently, October 21 and February 22, the results are nominal, plus 5% and 0%. And XRR has been 10 and 16, which is reasonably healthy compared to lump sum investments here. So, again, you can see that despite entering at drawdowns, you would have made good money. And if you entered at a 20% drawdown, in December 16, your lump sum CAGR is 26.7%, your XRR is 25.3%. In September 18, it would have been 24 and 30, and in Feb 22, it would have been 12 and 16%. So very, very healthy figures if the drawdown is 20% in any strategy. From there, if you are investing either in SIP mode or in lump sum mode, extremely good figures. 30% drawdown, extreme case, but yes, August 19, 35.92% CAGR and 32.69% CAGR. So extremely healthy figures when you invest on extreme drawdowns, and small cap index can have those extreme drawdowns. MI25 has similar figures. Again, after the small caps fell in March 2018, you have a XRR of 20.3%. But recently, in the last year and a half, you've had a flat XRR, and in from May 22, you had a slightly positive XRR. So basically flat, I would say, not performing in the last year and a half. But in 2020, if you look at a 20% drawdown, Then you're looking at 19 and 23% on the XRR. And June 22, which is not even a year back, you still had got a XRR of 11%, which is extremely good for small caps in the last 9 months or so. MI35, which is a pure small cap strategy, also has similar numbers. I'll not go through all the numbers, but November 16, again, 25% and 26%, June 18, 21% and 30%. And then on a 20% basis, you had a very healthy double digit XIRR even in 2018 and 2022. Similar numbers for MI All Cap, very, very positive numbers, 20% drawdown, extremely robust numbers. MI ATH, again, similar story here. Of course, very recently, if you see, then of course the performance on CAGR is not there. MIATH2, again, post August 21, the numbers have been nominal. But if you look at the past performance, it is extremely good on that front. So essentially, if I bring it all together, then no strategy so far has given a negative outcome across any 3 year period. The way market has been, we've had two reasonably dull years post two good years. So 2016, 17, 17, 18 were good years. 18, 19, 19, 20 were dull years. 21, 2021, 21, 22 were good. And 22, 23 has been a dull year since we started in April 16. We need to come with a mindset of staying for at least 4 or more years. My own sense, if you ask me, is 5 to 7 years is that sweet spot where a one major rally you will definitely witness in your journey. SIPs we have seen as XIRRs have done much better than lump sums. Hence, I always recommend you do SIPs and gradually bring in your money, because we never know where we are sitting, as at the top of a particular intermediate trend. So we could be sitting at a top and we bring in a lump sum, and that will ruin our, CAGR for a longer period of time. Try to increase your capital gradually. Don't go in all right at the start. I already said that. Invest adequately to keep your expense ratio minimal. This is very, very important. The strategy that you're investing in, please look at the expenses for that strategy and make sure that the capital that you are planning to bring in may not be the first go itself, but the capital that you're planning to bring in over the years, that should not result in a expense ratio of at least less than 1%, is my sense. So if the expense for a strategy is 10,000 rupees a year, plan to come in with 10 lakh rupees over that, or at least over a period of time. Or if some strategy is 5,000 rupees, plan to bring at least 5 lakh rupees in that strategy over a period of time. That is the sort of the best practices, I would say. So essentially, low expense ratio, regular SIPs, punctual rebalances, and 4+ years of time frame. This is sort of the template that the past history has provided us, and I'm talking about last 7 years here. But even if you go back and see the last 20, 30 years, the same template has worked. Whether it was the dull period of 2000 to 2003. Then you had a bull run 2003 to 2008. Then you had the drop in 2008. Again a major rally 2009. Then 10, 11, 12 were flat. Then 13 to 16 were really good. 17 was okay. 18 was down. 19 was okay. 20 was a bit down in the first half. So you will have these reoccurring, or almost like a cyclical pattern of bursts of market moving up, and then letting it go for some time, and then moving up and then letting it go. That is the sort of the underlying theme of the Indian market for the last many, many decades. And the way the runway looks like going forward, that will not change in the next few decades also. So with that, I will come to an end to this episode. But do watch this particular video. I'll put the link in the description. The long-term approach to successful outcomes on weekend investing strategies. This is a very good video where we share more data, and I would request you to have a data orientation in your approach, because otherwise everything is very, very arbitrary. It is all narrative, short term narrative based. We have seen so many stocks where the narrative is built up and we invest into it because of the narrative, and then later on we figure out that the narrative has not worked out, and then because we don't have an exit strategy, we don't have a plan around it, we lose interest in that stock, and the stock also likely does not perform so well. So thank you so much for watching this, and I will see you in another video. Bye.